Hi everyone! So recently, the optical sector has caught my eye following a sharp decline in the share prices of several companies in the industry. So I thought this was a good time to take a closer look at it. This video will be a little different from usual, as we are going to compare two companies at the same time. The global leader, EssilorLuxottica, and one of China's largest optical lens manufacturers, Shanghai Conant Optical. To understand EssilorLuxottica, we actually need to start with two separate companies, Essilor and Luxottica. Essilor's origins go back to 1849, but the first date that really matters for us is 1959. That year, the company launched Varilux, the first commercially successful progressive lens developed by the French engineer Bernard Metnas. A conventional single-vision lens corrects either near or distant vision. A progressive lens combines several correction zones in the same lens, allowing the wearer to see clearly at different distances. This is a more complex product to design and manufacture, and it generally sells at a much higher price than a basic lens. In 1972, SL and Essilor merged to create Essilor. The company then expanded internationally through production sites, prescription laboratories, and close relationships with opticians. Over time, it built a large portfolio around products such as Varilux progressive lenses, crisol coatings, transitions photochromic lenses, and, more recently, stellest lenses designed to slow the progression of myopia in children. So the original Essilor business was mainly built around corrective lenses, lens technology, and the services required to adapt those lenses to each customer. Luxottica followed a complete different path. Leonardo Del Vecchio founded the company in Italy in 1961, initially producing components and semi-finished products for other eyewear companies. It presented its first complete collection in 1971 and gradually moved from being a supplier to selling complete frames under its own name. The company then expanded through fashion licenses, acquired brands such as Ray-Ban and Oakley, and built a large retail network through businesses, including LensCrafters and Sunglass Huts. This gave Luxottica control over the frame, the brand, and increasingly the point of sale. Essilor and Luxottica completed their merger in 2018, and the acquisition of Grand Vision in 2021 added another large international retail network. The result is a company that can now operate across almost the entire value chain. EssilorLuxottica can design the lens and the frame, manufacture both products, own the brand, supply independent opticians, and sell directly to the consumer through its own stores and websites. Shanghai Conant Optical has a much shorter history and a much narrower business. The company was founded in China in 1996 and initially developed through the mass production of standardized resin lenses. These lenses are manufactured in large batches for common prescriptions and then held in inventory until a customer places an order. This is mainly an industrial business where production costs, volumes, product quality and delivery times are particularly important. Conant expanded its standardized lens capacity with the creation of Jiangsu Conant in 2006. Then in 2011, it began producing customized lenses. Unlike a standardized lens, a customized lens is manufactured after the order and can be adapted more precisely to the prescription, the frame, and the needs of the wearer. These products require more advanced equipment and software, but they also command higher prices and generate better margins. In 2013, Conant acquired Asahi Optical, adding a production base in Sabae, one of Japan's historic optical centers. 3 years later, it launched Asia's first fully automated production lines for customized lenses. Conant then continued to move toward more technical products. In 2018, it introduced 1.74 index lenses in the Chinese market. The refractive index measures how efficiently the lens bends light, and a higher index makes it possible to produce a thinner and lighter lens for the same prescription. This is particularly useful for people with strong prescriptions, and it also explains why a 1.67 or 1.74 lens can sell for much more than a common 1.56 lens. The company listed in Hong Kong in 2021 and began working on augmented reality glass lenses with North American customers in 2022. It is now also developing prescription solutions for smart glasses alongside its traditional range of standardized, customized, progressive, photochromic, and high-index lenses. This development is also visible in Conant's growing industrial scale. As we can see, its industrial scale has expanded considerably. Since 2018, sales volume has increased from around 101 million to 185 million lenses, while production has almost doubled. The latest global industry ranking, based on 2024 data, placed Conant as the largest resin spectacle lens manufacturer in China and the second largest in the world by production volume. Within that same market, it ranked 5th globally by revenue. So we are clearly comparing two businesses with very different scopes. EssilorLuxottica sells lenses, frames, brands, retail and services, while Conant mainly competes within the resin lens manufacturing part of that value chain. However, Conant is gradually moving from standardized volume products toward customized, high-index, and functional lenses. These are precisely the categories that were historically dominated by companies such as Essilor, Zeiss, and a small number of Japanese manufacturers. Now that we know what the two companies sell, we can compare where they operate. EssilorLuxottica generates the large majority of its sales in Western markets. In 2025, North America represented 44.9% of revenue and EMEA another 37.8%, meaning that these two regions together accounted for almost 83% of the group. Asia Pacific remains part of the mix, but it's still a secondary market at 12%, while Latin America contributes just over 5%. The historical figures are not perfectly comparable because the scope changed with a merger. But Asia Pacific's share of group revenue has clearly declined from the roughly 18 to 19% reported by Essilor before the combination. Conant's geographic mix is more centered on Asia. Mainland China generated 34.4% of revenue in 2025, while 65.6% came from overseas markets. But even within this overseas business, Asia, excluding China, represented around 37%. That is equivalent to roughly 24% of Conant's total revenue. Once this is added to mainland China, Asia as a whole accounted for approximately 58% of the group. Conant also generates meaningful sales in the Americas and Europe, so both companies are genuinely international. Their industrial footprint, however, are quite different. In 2025, Conant operated 3 production bases: Shanghai and Jiangsu in China, and Sabae in Japan. Its new Thailand base was not yet producing and was scheduled to begin operations in 2026. EssilorLuxottica has a much broader network, with 33 production facilities and 555 prescription laboratories around the world. This allows more of the lens finishing and prescription work to be carried out closer to its major end markets. So EssilorLuxottica combines global manufacturing with local laboratories, wholesale distribution, and retail close to the final consumer. Conant remains mainly an Asia-based manufacturer, exporting lenses to professional customers around the world. The difference becomes even clearer when we look at how their revenue is segmented. EssilorLuxottica is divided almost evenly between professional solutions and direct-to-consumer. Professional solutions represented 47.7% of revenue in 2025. In this segment, the immediate customers are independent opticians, optical chains, distributors, and third-party online platforms, which then sell the products to the wearer. Direct-to-consumer represented the remaining 52.3%. Here, the customer is the final consumer buying through one of the group's retail banners or its own e-commerce platforms. This dual model allows EssilorLuxottica to supply professionals through its wholesale network and sell complete pairs of glasses directly through banners such as LensCrafters, Sunglass Hut, or Vision Express. Conant doesn't have an equivalent consumer-facing segment. Its business remains almost entirely B2B, selling resin lenses to optical companies, distributors, and retailers. It therefore operates mainly within one part of a much broader value chain covered by EssilorLuxottica. With their business models established, we can now see how they have translated into revenue growth. EssilorLuxottica's revenue increased from Euro 6.7 billion in 2015 to Euro 28.5 billion in 2025. This looks impressive, but a large part of the increase came from changes in the group's scope rather than purely organic growth. The merger was completed in 2018, which explains the sharp increase in revenue visible in 2019. The group was then affected by COVID in 2020, before the acquisition of Grand Vision created another major change in scope from 2021. For a cleaner comparison, 2022 is a more useful starting point. From 2022 to 2025, EssilorLuxottica's revenue increased from Euro 24.5 billion to euro 28.5 billion, representing average annual growth of approximately 5.2%. Growth accelerated sharply in 2025, reaching 11.2% at constant exchange rates and 7.5% on reported basis. Conant's revenue increased from RMB 854 million in 2018 to RMB 2.19 billion in 2025, meaning that the business more than doubled in size. Of course, it started from a much smaller base, but this still shows that the company has been successful in expanding within the lens market. Using the same 2022 starting point, Conant's revenue grew from RMB 1.56 billion to RMB 2.19 billion by 2025. This represents average annual growth of approximately 11.9%, more than twice EssilorLuxottica's 5.2% growth rate over the same period. Conant, therefore, delivered the stronger underlying revenue growth, although its growth slowed to 6.1% in 2025, slightly below EssilorLuxottica's reported growth for the year. Revenue growth is only part of the picture. The next question is what happened to margins. EssilorLuxottica's gross margin has remained both high and relatively stable throughout the period. Since the merger, it has generally stayed above 60%, excluding the disruption caused by COVID. In 2025, gross margin declined from 63.4% to 60.6%. The main reasons were US tariffs and the growing contribution from lower margin wearables. The absolute margin levels should not be compared to literally because the two companies have very different revenue mixes. What is more interesting is the trend. Conant's gross margin increased significantly from 30.6% in 2018 to 42% in 2025. There are several factors behind this improvement. The first is a shift toward a better product mix, including a higher proportion of higher-end lenses. Other factors include better production efficiency through automation and economies of scale, and faster growth in Conant's own brand business than in ODM. Now that we have looked at revenue and margins, let's move on to earnings. At first sight, EssilorLuxottica's performance is rather disappointing. Reported EPS increased from euro 3.57 in 2015 to euro 5.04 in 2025. That is a total growth of around 41%, but a CAGR of only 3.5% over 10 years. However, the reported series makes the underlying progression look weaker than it really was. Since the merger, reported earnings have been reduced by substantial purchase price allocation charges linked to the EssilorLuxottica combination, Grand Vision, and other acquisitions. For example, in 2025, reported EPS was euro 5.04, while adjusted net profit corresponded to approximately euro 6.88 per share. Using adjusted figures, EPS increased from euro 4.46 in 2019 to euro 6.88 in 2025, which represents a respectable CAGR of around 7.5% per year. The comparison with Conant is striking. its EPS increased from RMB 0.42 in 2020 to RMB 1.2 in 2025. That represents total growth of approximately 186% or a CAGR of 23.4% over 5 years. And the contrast becomes even more interesting when we look at their financial structures. EssilorLuxottica ended 2025 with net financial debt of approximately Euro 10.85 billion, including lease liabilities. This is partly explained by the group's acquisitions and the leases attached to its extensive retail network. However, the debt remains manageable, with net debt representing around 1.7 times EBITDA in 2025. So the group is using financial leverage, but its balance sheet is not a major concern. Conant is in a very different position, with approximately RMB 1.18 billion of net cash at the end of 2025. Part of this cash came from the issuance of 53.3 million new shares to Goertek, a large Chinese manufacturer of electronic components and AR and VR devices. Conant raised around HKD 828 million through the transaction, specifically to develop and manufacture lenses and vision solutions for smart glasses and XR headsets. Even with these new hands, Conant's financial position remains particularly strong. And this was achieved while the company continued to invest in both R&D and production capacity. EssilorLuxottica's R&D spending increased from Euro 214 million in 2015 to Euro 664 million in 2025, while remaining relatively stable at around 2.3 to 2.4% of revenue in recent years. Conant's R&D spending increased from RMB 35 million in 2018 to RMB 97 million in 2025. Its R&D intensity also increased slightly from 4.1 to 4.5% of revenue. That investment effort is visible not only in R&D, but also in capital expenditure. EssilorLuxottica's CapEx has remained close to Euro 1.5 billion per year since 2022, representing around 5.4% of revenue in 2025. Conant's CapEx reached RMB 291 million in 2025, or 13.3% of revenue, as the company invested in new production capacity and higher-end equipment. Let's now see how earnings and investment spending translate into free cash flow. For EssilorLuxottica, the picture is more positive than the reported EPS chart suggested. Free cash flow per share increased from Euro 4.09 in 2015 to Euro 8.2 in 2025, meaning that it essentially doubled over 10 years. Based on the current share price, EssilorLuxottica trades at approximately 19.7 times free cash flow. For Conant, we can clearly see the impact of a capex cycle on free cash flow. Free cash flow per share has been much more volatile and remains relatively low, as a significant part of a company's operating cash flow is currently being absorbed by investment in new capacity and equipment. Now on dividends, at the current share prices, EssilorLuxottica offers a dividend yield of approximately 2.4% compared with 1.3% for Conant. With a financial comparison complete, we can now step back and summarize the long-term positioning of these two companies. EssilorLuxottica is the clear global leader. Its main strength is that it operates across almost the entire value chain, from lens and frame manufacturing to distribution and retail. It also owns proprietary technologies and some of the best-known brands in the industry. These brands are a real competitive advantage because eyewear is both a medical product and a fashion accessory. Many consumers are willing to pay more for names such as Ray-Ban and Oakley, particularly when the brand is visible on the frame. However, this advantage may become slightly less powerful during periods of high inflation, when households' budgets are under pressure and consumers become more sensitive to price. Some customers may postpone replacing their glasses or choose more affordable frames and lenses. The more direct competitive pressure is in lens manufacturing, where EssilorLuxottica is facing growing competition from companies such as Conant. Conant combines a lower-cost production base with rising R&D investments. It is gradually moving beyond lower-priced, standardized lenses into customized, high-index, and more technologically advanced products. For now, this challenge remains concentrated in lens manufacturing rather than across EssilorLuxottica's entire business. However, if Conant continues to improve its technologies and product quality, it could gradually reduce EssilorLuxottica's ability to charge a large premium for some of its proprietary and most advanced lenses. Despite this competitive pressure, I remain positive about the long-term outlook for the sector. The aging of the population should continue to increase demand for progressive lenses and other solutions related to presbyopia. At the same time, the growing prevalence of myopia among children and young adults should support demand for corrective lenses and more advanced products designed to slow its progression. There is also still considerable room for growth in emerging markets, where access to vision correction remains lower and where rising incomes should allow more consumers to move from basic lenses toward thinner, customized, and higher quality products. These trends should benefit both companies, although in different ways. EssilorLuxottica is particularly well positioned to capture the premium part of this growth through its technologies, brands, and distribution network. Conant can benefit from rising volumes, more price-sensitive consumers, and its gradual move into higher value lenses. Both companies are also beginning to diversify into smart glasses. EssilorLuxottica has the most visible position through its partnership with Meta, while Conant is developing optical components and prescription solutions for these products. I haven't focused on smart glasses so far, but they could become another long-term growth driver for both companies. To conclude, let's look at valuation and at what I personally think of these two stocks. Both companies are currently trading around the -2 standard deviation line of their respective logarithmic regressions. This doesn't necessarily mean that they are undervalued, but it shows that their current share prices are significantly below their historical trends. For EssilorLuxottica, however, the reversal has been extremely sharp. At around euro 162, the share price has almost been cut in half from its 2025 peak above euro 300. In my view, part of that peak was driven by the hype surrounding smart glasses and, more specifically, EssilorLuxottica's partnership with Meta. This is something I'm always cautious about in financial markets. Investors become extremely enthusiastic about a new activity and start pricing in its potential before its real economic contribution is clear. Since then, the competitive landscape has become increasingly crowded. Xiaomi has introduced its own products, while Google is developing an Android XR ecosystem with several eyewear and technology partners. Meta has also launched a more accessible collection under its own brand, starting at $299. However, these glasses are still developed in partnership with EssilorLuxottica, so they are not a direct competitive threat to the group. Nevertheless, they show that this category is likely to become increasingly competitive with more brands, more products, and potentially greater pressure on prices. For me, the long-term value that smart glasses will ultimately create for EssilorLuxottica remains far from evident. At the prices shown here, EssilorLuxottica trades at approximately 19.7 times 2025 free cash flow, while Conant trades at approximately 21.2 times 2025 earnings. These two multiples are not directly comparable, but each is the more relevant measure for the company concerned. Even though I really like Conant's geographic footprint and believe that its growth potential is higher than EssilorLuxottica's, at the current prices, I still prefer EssilorLuxottica. At around 19.7 times free cash flow, I also think EssilorLuxottica has reached a price level where investors interested in the sector could start building a position. It remains the global leader with a stronger competitive moat, recognized brands, proprietary technologies, and control over a much larger part of the value chain. Conant is growing faster and gradually moving into more advanced products, but it remains a narrower, China-based business. Given the additional country and geopolitical risks, I will need a more attractive valuation and therefore a clearer discount to become interested in the stock. More broadly, conducting this analysis was extremely important. Whenever we analyze a company outside China, we should increasingly ask the same questions. Who is its Chinese competitor? How quickly is that competitor improving? And could it eventually threaten the company's market share, margins, or ability to charge a premium? In the optical lens industry, Shanghai Conant Optical is clearly a competitor that EssilorLuxottica investors should continue to watch. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe, and share.